Hi everyone. Thanks so much for joining. It's been a bit of a hiatus, but we're back for our non-farm payrolls live. And of course, we are waiting for the big one. This is the first payrolls report since September, so post the government shutdown. So let's just dive straight into the charts. We've got a few minutes before we get the data, so let's take a look, as usual, at my favorite chart. This is world equity markets. Obviously, US markets aren't open right now, so if you just follow my pointer, you can see European markets, a bit of a sea of red, bit of a neutral move there for the CAC, and that follows on from some steep losses in Asia. Actually, look, that 1.5% drop in the Nikkei, 1.5% drop in the Hang Seng, and then we did see some weakness as well in the S&P 500 and the Nasdaq. Now they were dragged lower by tech names and Bitcoin, so that really suggests that there's a bit of sentiment seeping out of the market as we move to the end of the year. Hopes for that Santa rally, they really are starting to fade. But what's really interesting, now you can say this about lots of things over the markets, but there is a bit of a pattern whereby if markets don't rally in December, they tend to pick up in January. Now, I wrote in my note this morning that what we're seeing is maybe investors taking money off the table a little bit earlier than expected this year. We've had a great run since April, so no wonder. Big investors, they might be looking to just kind of glide into the end of the year and instead come back in January. And that's what we could see. We know that there's historical correlation with weakness in December leading to strength in January. So that's something definitely to watch. But it certainly seems like it's going to be a choppy end to the year with no real theme. But of course, today's data is going to help us with that. Now, I want to show you one thing. This is an unusual chart for me. It's heavy truck sales in the US. I don't think I've ever probably shown you this chart before, but really look at the trend since the start of this year, since December last year. It's the trend so far has just been absolutely lower. So it's gone down to the lowest level since 2020, and that has a positive correlation actually with the unemployment rate. So the US heavy truck sales tends to be a lead indicator. When you stop buying heavy trucks, that is a real lead indicator of economic weakness, and that leads through to a higher unemployment rate. So let's just run through this data really quickly. We're expecting 50K in non-farm payrolls for November. Now, we're also getting the October release. That could actually be really, really negative because of deferred Doge federal worker redundancy plans. We've also got an unemployment rate that is 4.5% is expected. Now, that could actually be stronger than expected, not just because of the heavy truck sales, although that does suggest that we will move higher with unemployment, but also because of, again, those deferred redundancies from those federal government employees. So Doge, Elon Musk's Doge, still having a really big impact. We've also, of course, got retail sales. They're expected to remain fairly moderate, with control group sales rising at 0.4%. So they are expected to bounce back from that decline in September. But equally, we have no idea what the I think this data could be very, very noisy, and it has been very noisy with very weak sales, including autos. So we will be looking at what the retail sales are doing. We've got pretty moderate average hourly earnings growth as well, 0.3% on the month increase on the month of November, with a 3.6% rate there. I think if we get something around the 50K mark, that will be pretty, that will give the kind of, it will suggest that what the Federal Reserve has done, 75 basis points of rate cuts in the last three since September, that would be validated. Obviously, if you get a much stronger number, now that's going to be a bit of a problem. I would say there still is a lot of noise in this data. As I mentioned about the unemployment rate for November, that was actually the data was collected when there was still workers on furlough. So it's going to be very noisy. This is a complex set of data releases. It's not going to be easy to read. So I think the cleanest bit of data that we're going to get is the non-farm payrolls report for November. And I think that's going to be the most market moving. We've got about 45 seconds, so I'll just quickly show you what's going on. This is the dollar index. It's below its 200-day moving average. As we say, when anything's below its 200-day moving average, nothing good happens. We are weakening now down to that 98 level into this payrolls report. We've got bond yields fairly stable. This is the 2-year yield, so absolutely flat. Of course, there would be a bit of increase there in the United Kingdom. We've got, let's just look at interest rate expectations currently. For next year, they're looking at just over two extra rate cuts from the Federal Reserve. So still expecting those rate cuts. Remember, the Federal Reserve themselves only expect one rate cut next year. So let's see there we go, 10 seconds now. Let's see what this is going to give us. The countdown is on. Oh, it's coming slowly. Oh, 64K. So slightly stronger. Yes, an increase in that unemployment rate, 4.6%. That doesn't act, that may be overstating things a little bit. And let's take a look at retail sales. That is much stronger than expected. So we've got quite moderate non-farm payrolls, which really are in line with estimates. So probably not going to be the most market moving. Let's look at average hourly earnings. Oh, 0.1%, much weaker than expected. Year on year, 3.5%. We've got this basically suggests that, yes, we've got a cooling in the US labour market. Underemployment rate, labour force participation rate ticked up a little bit. But again, this is all going to be subject to revisions. So we do need to point that out. But a 64K, 50K expected. That's actually not too bad. Likewise, a bit of a stronger than expected reading for private sector payrolls as well. And that exact spot on -5,000 decrease in the manufacturing payrolls. The retail sales here, as I said, very, very strong. So 0.8% in that control group. That's a real bounce back from the September reading of 0.1%, or minus 0.1%, sorry. So there was a contraction in sales in September. Really bounced back with a bit of gusto there in October, which really suggests that that government shutdown has not had too much impact on retail sales at all. And people are buying in October. Remember, November is Black Friday month. So people were, not necessarily bringing forward purchases because why would you? But they're not delaying them for Black Friday. So it suggests robust US consumer and I would say a moderately cooling US equity, US labor market there as well. Let's take a look at what's going on with the dollar index. Again, as I said, not going to be the most market moving piece of data now because it was roughly in line with expectations. Let's take a look at bond yields as well. Oh, bond yields have fallen though. I think there was an expectation that we'd get a stronger payrolls number than expected, that we'd see a real bounce back in payrolls for November. That really hasn't been the case. We're still quite moderate on payrolls. So hence why we're seeing bond yields, the 2-year yield, follow my pointer here. That is down 4.6 basis points at the moment. What's this? The 2-year yield. Yes, exactly. This is it in visual form. That has fallen really, really, really sharply on the back of that data because it wasn't expected. Let's take a look at what's expected. If this has moved interest rate expectations at all, it might be a bit early for us to see this, but yeah, still expecting those 2 rate cuts next year. So I think that this data will basically show that the Federal Reserve will stick to their guns when it comes to the Federal Reserve. Sorry, the market will stick to their guns, that the Federal Reserve may have to move more in line with the market rather than the other way around. Overall, yeah, this is a really interesting bit of data. We've also seen a pickup in New York Fed services business activity. That's for December. So it had been minus 21.7 in November. Now it's picked up a bit in December. It's still obviously negative, but a lot of these survey data, they are quite negative. Now, later on this afternoon, we've also got PMI, manufacturing PMI. But let's just see if that dollar has made any move. As you can see, absolutely not. Trading sideways. It's not in recovery mode either, but it's not falling any further because it wasn't worse than expected. And I think that moderate decline in payrolls, that's what this was today. That had all kind of been priced in already. Instead, what we're seeing is that actually not having that upside surprise to payrolls has had more downside on bond yields than it's had on the dollar. But I think this decline in the 2-year yield now, we're down nearly 4 basis points, just kind of whipsawing a bit. But, a significant shift lower on the back of that data point does suggest actually that we're going to, it's going to be really hard for the dollar to recover. Now, if we just look at dollar, just look at the dollar index, and then I'm going to take a quick look at dollar yen and at euro dollar. That really suggests at this level that we're not going to get back above that 200-day moving average. Oh, we're just about to cross the 200-day moving average cross below the 50-day moving average, which is another really negative technical signal. So it looks like those highs of 99.27, which was the 200-day moving average, they're well and truly behind us now, and we are trading around about that 98 level, which does open the door then to 96 in the dollar index. Let's just take a look at dollar yen, because remember Friday, we are expected to get the get a rate hike from the Bank of Japan. Now, as you can see, really interesting for dollar yen. It is testing its 50-day moving average. Now, we did mention this, that if we did get kind of a moderate or a slightly weaker payrolls report, that we could test this key level. This was the exact level we mentioned. Comes in at 154.21, currently trading at 154.60. So not quite there yet. But if we get a close below that 154.20, either today or even tomorrow, then that would possibly solidify a bit of an about turn for dollar yen. And that recent bout of weakness that we've seen throughout December, we saw a bit of it through November as well. That could really take on a mind of its own and really start to weigh on on dollar yen, and we could get back to that 150 level pretty quickly, because remember, we do have what the Federal Reserve is doing, the Bank of Japan is doing the exact opposite. They're hiking rates and they're trying to pull back and shrink their balance sheet. The Federal Reserve is trying to expand its balance sheet, and also it has obviously been cutting interest rates. But I think this data today suggests that they were dead right to do everything they were doing. Let's take a quick look at gold as well, because I had mentioned that if we got a stronger than expected apologies, payroll price, that we could see some weakness in the gold. Gold has had a fantastic tear higher this week. It hasn't quite made new record highs, but it's just up literally just $2. Let's take a look at it. Just today's price action in gold. And yeah, I mean, we're not really doing too much. We'd kind of fallen at the start of the day, then we recovered losses. It doesn't really know what to do with itself at the moment. But I think right now, 4,300, we look pretty comfortable above there, but I don't think we're going to kind of extend those gains right now. And if anything, I think the bias is to the downside, but there's obviously some really nice support there at 4,270, which has been the lows of today. So I think gold price probably biased lower, dollar definitely biased lower, especially against the yen, because of what we're going to see on Friday, what we expect to see on Friday from the Bank of Japan. Equities, now they've got their own thing going on. I don't necessarily think that we're going to see a big move, but we have seen, so if we just look, so as I mentioned, we've got some weakness there in Europe, but it's very mild and moderate. Now we have seen futures turn positive in the US on the back of this data, so expecting a moderate rise, 0.2% in the S&P 500, basically flat for the NASDAQ. They've got their own problems going on. Obviously, Oracle has come under a lot of pressure, Broadcom under pressure yesterday, and any of those markets linked and stocks linked to Bitcoin as well, they fell because Bitcoin's been really struggling. In fact, it went down to 85,000. We'll just take a quick look at Bitcoin, just because so many of the Bitcoin linked stocks are weighing on the S&P 500 this week. Bitcoin is currently trading at 86,000, so it's picked up a little bit on the back of that, purely because it reinforces that the Fed can kind of, you know, gradually cut interest rates, and maybe 2 rate cuts should be what we expect for next year. So maybe the Federal Reserve will have to start to fall in line with the market. So thanks everybody for joining. We really appreciate it. Thanks for joining our non-farm payrolls, and we'll speak soon.